But while the Dow and the markets may not be tanking a lot today, there is something that has been very interesting going on as of late. Long-dated government bonds are being bought big time. The 10-year yield has now fallen in 8 straight sessions. The last time that happened was back in January of 2008. It smells a bit of fear. But here's what's odd. Stocks seem to be telling a slightly different story. Now, generally, stocks and bonds go in different directions. But look at this year, right? The blue line is the S&P 500. We've been up, we've been down, we've been up again, right? Well, the light green one, yellow, Seahawks green, whatever you want to call it, is the price of the 10-year Treasury note. Now, at the start of the year, as we usually see, the two were going in opposite directions, right? We had some flare-ups midsummer. We started to see the two converge, come back to each own. Now, halfway through the year, we did what we normally do. We diverged again, but look at the very far right, folks. They are coming back together. When people get scared, they often sell stocks and buy bonds. Is that what's going on here? Let's get Rick Santelli's take on this. Rick, what do you make of it?
Oh, I think you nailed it, but I also think that there's a bit of a water balloon metaphor or analogy to this as well. The Federal Reserve has this giant water balloon, and they're trying to manage it. That water balloon represents all the markets in the U.S. economy, and they're trying to squeeze it, to use quantitative easing to help asset prices mostly in stocks. And what happens is the distortions are going into the second derivative, so it gets very difficult to tell, risk on, risk off, what's real, what's memorized. But quite simply, the issues in Europe are the poster child, and I think the U.S. has similar ones, but the issues are running much ahead of the cure or the medicine, meaning the deterioration in the economic horizons, whether or not France is moving into recession, Spain moving into junk in terms of rating agencies, that those are real world economic fundamentals, and they're causing the treasury market and the bond market and the safe harbors to reprice again. But what's fascinating is if you look at a chart today, we had new home sales. It wasn't a bad number, best since basically 2010. But if you go back to 2000 and you look at this chart, all of 04 and 05, Brian, all of it was above 1 million annualized units in new home sales, with the peak close to 1.4 million in mid-05. So the fundamentals near term are improving, but in the big picture, they're really not. And now you look at that chart of 10 years, we're at a 3-week low in yield, which you just pointed out, and I think stocks are going to slip right along with these yields.
So, Professor, you're kind of like my dad, right? Because I used to come home maybe with a D, and if I brought home a C-, I would say, hey, Pop, look, I got better. He still wasn't happy.
Yeah, it's a perfect analogy, Sully.
Rick Santelli, thank you very much. Sometimes you get it right. All right, let us stay on the fear and loathing trade with the bond king himself, Bill Gross, PIMCO founder and co-CIO. Bill, you seem to have nailed it. Back on August 24th, you tweeted out that a good common sense bottom in the 10-year bond would be a yield of around 1.5%. Are you still sticking by that? Is that the low?
Yeah, I think so. It's hard to know when the Fed or other central banks, keep throwing hundreds of billions of money into the pot. Obvious consequences come out of that. What we've seen in the stock market is that, for the year it's up, close to double digits, plus or minus, and that in the bond market, when you use the PIMCO Total Return Fund as a proxy, it's up close to 10% too. How do those things happen? It happens simply when the Fed, creates money, and that's what we're seeing at the moment.
And your fund has beaten 9 out of 10 competitors in bond funds like yours, so you are up for the year, well above your benchmark. You've done well. We know that you have sold some treasuries. We also know, according to the Wall Street Journal, you've had a nice inflow of new investor cash. Where are you putting the new cash and the sale proceeds to work?
Well, thank you, Brian, for that compliment. We hope it keeps going. No guarantees. Where are we putting the money? Yes, there's several places. One, in terms of the Fed, we correctly anticipated and continue to anticipate what the Fed will be buying. They've told us that they will buy $40 to $70 billion worth of mortgages, agency mortgages, every month until the cows can come home. And so, it pays to own those mortgages, despite the fact that they're, significantly overvalued. guaranteed. Second of all, what is the ECB going to do? No guarantees, but they've basically told us that they're going to be buying Italian and the Spanish 1 to 3 year debt should those countries apply, for a rescue. And so, yes, the riots on the streets in Madrid are a little bit troubling, but basically in the next 2 to 4 weeks, we think that Spain and eventually Italy will be the recipient of, the central bank buying bonds, and so you want to buy them before they buy them.
We talked about that before, Bill, and it's a point that I keep coming back to, which is if we see a euro bond, there's no guarantee we will. Some do, some think we won't, whatever. If we see it, or if we see more bonds issued, is that going to dramatically reduce demand for U.S. Treasuries?
Well, I think to some extent, to the extent that German bonds and U.S. Treasuries, the 10-year, now basically both of them somewhere between, 1.6 and 1.7%, to the extent that those are flight to quality instruments, then if things settle down, and yes, as of today, they're not settled down, but if they settle down, then, logically, some demand would come out of those areas and into the riskier areas with the higher return and higher opportunity. I think that would be the case.
What's your view on mortgages? You've probably heard Rick say, listen, home sales have gotten better, but it's off a dramatically depressed bottom. Do you think housing has hit bottom? Has the mortgage market hit bottom?
Yeah, it looks like prices have, but it doesn't really mean that it's going to be a leader in terms of economic growth like it has in prior cycles. Housing is about 3% of GDP. Typically, people have bought refrigerators and washers and the like, and we've had a consumer boom following a housing, upturn. This time, structural differences suggest that, probably not. The homeowner is too much in debt, and therefore, you would see a limited upturn. But I think housing has bottomed, and that's what the Fed wants to do. The Fed wants housing prices and other prices to increase. It's below their 2%, basically target. And so raising prices not just for homes, but for other goods and services, hopefully labor, is really their objective.
Don't know if you have a view on this, but we had one of your colleagues and friends, Scott Meinert of Guggenheim Partners, obviously a competitor, a frenemy, I guess is the proper term. He came on this show shortly ago and he said, I'm buying European stocks in a big way. I think the worst has been done with equities in Europe. Do you agree with that?
Well, stocks are depressed. There's no doubt about that. The fortune of Euroland equities depends upon the ability of the ECB and, structural changes to stimulate growth. At the moment, the only growth that we've really seen is in Germany and the northern parts of Euroland. That's sinking as well. So it's one of those periods of time where, there's blood on the streets. Do you buy when there's blood on the streets? Yes, the Rothschild said do that. And so I wouldn't recommend against it. I'd simply say, that real growth is an essential element of this particular recovery, and unless we see it, then equities and, of course, Italian and Spanish bonds aren't going to do well.
Final question in 2 small parts. Do you think we should go over the fiscal cliff? And if we did, and taxes go up on everybody, will that bring us back to a AAA credit rating? And if so, what would you do about it?
No, we shouldn't go over the cliff. We should seek a remedy. I'm about to put out an investment outlook, Brian, in the next few days that basically suggests that the United States, along with some other rogue countries such as Greece and Spain and France, are in this category of what is called a high structural deficit. It means that we need to, over the period of the next few years, maybe 5 to 10 years, reduce our deficit, our structural deficit by about $1.5 trillion a year. And that's a lot of heavy lifting. Can we do that? Yeah, perhaps. But the United States has gotten itself into a corner in terms of high debt level, and it may lower real economic growth going forward.
And we didn't even bring up a picture of Wimpy, the fat cartoon character, who you referred to in your last note. Bill, we'll look forward to your next one coming up here very shortly, I think.